Okay, everyone, welcome back to the channel. Now, this is a question I get a lot. I've had recently, right? And I understand coaching some students, right, that a lot of people tend to get this problem when it comes to trading the lower time frames, the intraday or the lower time frames. Now, how do you identify a breaker structure versus a liquidity sweep, right? Both are incredibly important when it comes to your trading, right? So a breaker structure and a liquidity sweep. So just before we go on the charts, I'm going to show you a quick schematic of what we mean by this, right? So essentially we're going to be using what we call the power of three. So the power of three comes in essentially three steps, hence the name. So we have an accumulation. Now the accumulation itself, what we refer to as the Asian range. So the Asian range from 8 p.m. to midnight Eastern Standard Time producing liquidity, right? So this is what we're going to label in orange. Now we have buy side liquidity resting above, and we have sell side liquidity resting below. Now from here, we're going to be identifying a breaker structure versus a liquidity sweep. Now, typically, the first thing you want to get into your brains or into your notes first and into your brains is that the order in which these come in, right? Typically, when you are looking for a breaker structure versus a liquidity sweep, it's important to understand a few things first, right? So first of all, it's important to understand market bias, right? Which I am going to be going over a very brief overview on the Euro USD case study we're going to be going over, right? But market bias is very important. Is the market moving up or down? Are we bullish or bearish, for God's sake? Please get this right, because if you can get this right, you will naturally, have a lot less problems when it comes to understanding this, right? The second thing we want to look at is time, and time is very important. Timing is the key here, right? And I'm going to show you in a little bit more detail what I mean by time specifically. But timing we refer to as a session. What session are we? Are we in London? Are we in New York? Are we in Asia? Are we in Frankfurt? All the different sessions, Sydney, Tokyo. What is the time and what session are we in? Now, the third thing you want to look at, this is also very important, right? You want to use the economic calendar, right? So you want to use the economic calendar. And why do we need the economic calendar? Well, for those people who have been trading and who have done back testing, forward testing, who have experience in the market, what you understand right away is that the economic calendar often has, big news events, as we know, red folder news events, should I say. So you've got the NFP, the FOMC, the CPI, the PPI, you have all these news events which inject volatility, which inject volume into the market, right? And what happens with these is that these events are responsible for two things, right? So if we quickly key off this, right, the economic calendar is responsible for two things. Either it manipulates, which is what most people understand, but also it can distribute. And that's what people often miss, right? It can also distribute as well. Okay, it can accumulate and it can distribute. This is very important. So when you have a news event at, let's say, 8:30 Eastern time, right, 8:30 a.m. Eastern Standard Time, it's important to understand that we are likely to see a liquidity sweep there before we see a structural break. And this leads me nicely on to the next point, right? In what order does these events occur? Do we see a liquidity sweep first, or do we see a breaker structure first? So let's quickly go over this schematic so we can understand, or so people can have a rough understanding of what we're going to be going over. So once we've had the Asian range, right? Let's say we have a bullish day, right, which is currently my bias in euro dollar. I'll explain later on in the video. Once we have price sweeping lower, we've swept the Asian range low, right? We swept the Asian range low. We keep heading lower. And now this happens. Okay, so what have we actually seen over here, right? So first things first, we have the A, which stands for, as we all know, accumulation, the first phase of the power of three. Now, the second thing we need to look at is we need to look at what's going on over here, right? So technically we have a bearish breaker structure over here. Technically, this is a bearish breaker structure. Now, I'm sure there's a lot of people out there, degenerates on the 1 minute time frame, who will try and trade something like this. Now, in theory, there's nothing wrong with that. Of course, you're going to get stopped out. And the reason why you're going to get stopped out there is simply because of the thing I mentioned right at the start, right? Market bias is very important. What is your bias? What is your bias? Get your bias correct, right? Once you have your bias correct, you now want to ask yourself, is this the breaker structure I need to be looking for? Or is this the breaker structure I need to be looking for? And this leads me nicely to my point, right? Now that we have an accumulation over here, what you want to look for is you want to look for a liquidity sweep before the breaker structure, because you now need to understand what these things actually mean, right? What is a manipulation? What is a liquidity sweep? And what is a breaker structure, right? So if I give you the more formal definition from an SMC or an ICT perspective, however you want to call it, we have a manipulation over here, right? This is the ICT Judah swing or the turtle soup or simply manipulation. It's whatever you want to call it. Let's call it manipulation, right? Just to keep things simple. Now, when we have a manipulation in the markets, a manipulation occurs to trap, in this case, trap sellers onto the wrong side of the market against the market bias. Notice how I keep going back to number one on the top right. Market bias is very important. So this is a form of trapping traders, right? This is what we call trapping traders, or simply manipulating, as the name suggests, right? So this is what we call the Judah swing, or you can call it the turtle soup, or there's lots of other names for it, right? The manipulation or the liquidity sweep, right? A manipulation is the liquidity sweep. So you want to ask yourself, when we see a manipulation, you want to ask yourself, well, why are we seeing manipulation? If we have a bullish day, what is the purpose of this move? Always break things down in terms of purpose. What's the purpose of this move over here? Well, this move over here is an enticement of sellers, right? Enticement of sellers. And so this is the liquidity sweep, right? Notice how the liquidity sweep happens down in this region, but the breaker structure happens here, right? So let's label this BOS, right? Or people call it market structure shift, we call it a breaker structure, right? BOS, right? Break of structure. Now, what does the breaker structure represent to us, right? The liquidity sweep is a manipulation. Now, the breaker structure shows signs of distribution, right? So this is the third phase of the power of three. So again, we have the accumulation, or A for short. We have the M, which is a manipulation. And the breaker structure gives signs of a distribution. So this is the first phase of a distribution, right? Distribution comes in different phases, right? So what do we mean by the distribution, and what do we look to catch, right? So from here, what we look to catch essentially is we're looking for a breaker structure, and we're looking to essentially key off a fair value gap in a discount. That's all you're doing. So essentially what we're doing is we're projecting the Fibonacci to from the swing low up to the swing high. And notice how we're looking for a fair value gap to key off, right? So this now gives rise to our order block. So this is an order block. What is an order block? Well, an order block is simply an area you want to buy yourself from. It's as simple as that, right? Another quick question I get, not to get off topic, is what's the difference between an order block and a POI? An order block is where we want to buy from and sell from. It's a definite area on our entry time frame. But a point of interest is a higher time frame, essentially a higher time frame point of interest, where we're not looking to directly trade from, we're looking to analyze price on the intraday to lower time frames to potentially take an entry from there. So a POI is an indefinite trading point, whereas an order block is a definite trading point, right? But going back to the main topic of today, it's understanding the difference between a breaker structure and a liquidity sweep. So let's quickly go on the charts now and analyze some euro dollar price action, right? So again, we're going to go down now to the lower time frame, right? We're going to go down to the 1 minute time frame, because I'm going to show you the power of what I mean by this, right? So here we have the euro dollar on the 1 minute time frame. Again, not necessarily the best time frame to trade, and I'll tell you why. Well, okay, we're going to be going into structure and time specifically. So now that we see the Asian range over here just completed, we see price heading up. before heading down. Now from here, the first, I guess, in quotes, break of structure happened over here, right? So yes, I'm looking at this in hindsight, but there's a reason I'm looking at it in hindsight because I need to explain to people how to analyze price. Now that you see it, now that we've seen a break of structure over here, this now marks up a break of structure. We have a fair value gap. We've also, it's also priced in the discount. So yay, happy days. Well, what do we see over here? Obviously, you're going to lose, right? Now, why do you lose? Is it hindsight? Well, it could be hindsight. This could have worked. But what is the reason why this is a low probability trade idea in the first place, right? Well, the first thing is typically for beginners, I don't recommend going down to the 1 minute time frame unless your edge tells you to, right? But now from here, notice how the low of the day actually occurred here in this region, not this region, right? So let's quickly label these and give it some perspective, right? So here we have a low. Let's label this in red as it wasn't the correct low. And here we have the real low. So let's label. Oh, where have we gone? Where have we gone? Sorry for this. And now from here we have the real low, which is just over here. Sorry for that. Now that we have the real low that's been established over here, this is the ICT Judas swing, right? So now you want to ask yourself, what is the difference between this low and this low? Well, the answer is one thing, right? What time did this occur? So if we convert this to New York time, this was roughly 2 o'clock in the morning, right? This is 2 a.m. Eastern. Okay? What time did this occur? This is 3:20 a.m. Eastern. There's a big difference when it comes to this. It's an hour and 20 minutes, almost 90 minutes different, and the 90 minutes different, sorry. And the reason for that, the reason why I'm bringing this up, sorry, the significance of this is that time plays a crucial role. So what I'm going to do is I'm going to now head up to a higher time frame, the 15-minute time frame, where we can analyze this in a little bit more detail. Okay, so we have two lows over here. Look at this on the 15-minute time frame compared to the 1 minute time frame, right? It's pretty obvious why this is the Judas swing. And the reason why this now becomes the Judas swing is simply because it's occurred in the correct time zone. So what do we mean by correct time zone? If you're trading the Euro USD, right? If you're trading the Euro USD, the Pound USD, or anything Euro GBP, anything Euro or GBP related, your best bet to look for your low of the day, your Judas swing, your manipulation, right? This all ties into the Judas swing, right? Your manipulation, if I can spell that correctly, or let's call it Judas swing instead. Your best bet for looking for a Judas swing occurs between sorry, I'm talking UK time. So it's 3 a.m. to 4 a.m., right? Eastern Standard Time. This is going to be your highest probability Judas swing, especially on a pair like Euro USD or GBP USD, right? So besides the point of time, the reason why people mess up breaks of structure versus liquidity is because they don't understand what they're looking for. This comes back to bias, but it also comes back to time, right? What time are you trading on? Right? What is the time you're trading in, right? That's the first thing. Now, the second thing to understand, this is very, very important to understand as well. So if we head down now to the lower time frame, let's try the 5-minute time frame, right? So I made a separate video on this, and I'm going to highlight the importance of it again. A break of structure, a high probability break of structure, right, occurs with a body break. And this is important to understand, right? So notice how if we were to label up structure like this, we will see something like this. We'll see a low, pull back to a high. We'll see a low, we'll see a high. Now let's zoom into price action. Let me point something out to all of you. This was the previous low over here, right? You can see very clearly we've wicked below this low, right? These are wicks. These are wicks, right? Another another point to understand with manipulations, right, is that manipulations occur often with wicks, right? Look out for wicks versus bodies. Very, very important. This is the lesson now of wicks versus bodies. Manipulations occur often with wicks. Breaks of structure occur with body breaks, and that's a very good way you can avoid the losses from a confusion between liquidity versus breaks of structure, right? So now to bring something else to your attention. Is this really your high, this swing high over here? Is this really a high? Because this is the previous low. Is this really a high over here? Is this really a high? You want to ask yourself, pause the video and ask yourself, is it really a high in the markets? Well, the answer is no, because this high didn't break the previous low. It wicked it. It swept it. So a very quick note to understand is that this is not the high. This is the high. So your breaker structure isn't here, right? This is incorrect. If you were to label this a breaker structure, this is an inaccurate breaker structure. It's not your high probability breaker structure. This is your breaker structure. And the reason for that is simply because this high broke the previous low with the body. So we can confirm this as a real high. This high over here swept the previous low, right? And this therefore gives indication of a liquidity sweep, right? Because we see the wicks. So we have wicks over here, which is something we need to consider. This is wicks. But then when we go up here, what do we see? Do we see price wicking above the old high? Or do we see price breaking with the body? Well, the answer is it breaks with the body, right? As we can bring the arrow over, we can see clear breaks of structure over here. So this is a break of structure. And the reason it's a break of structure is because it goes with the body. Remember the double B, right? Break with the body, right? B for B, break with the body, right? And manipulations are with wicks. So that's probably the one thing you can take away from this video, right? So, sorry. Once you've understood that, from there it's a case of simply, zooming out and understanding the rest of the entry model, right? So we understand we have a dealing range. Now our dealing range consists of this swing low up to this swing high. Now, once you have the high and the low established, from here it's a case of using the Fibonacci. You project it from the swing low up to the swing high. And notice how we come into the equilibrium, just beneath the equilibrium. So we've come into a discount. Very important to understand. This is now a discounted low. So once we come into a discount, from here the entry, you're simply keying off this minor fair value gap over here, right? So we have an inefficiency or a fair value gap over here. Stop loss below the Judas swing. And from here, we had a nice London scalp, right? Nice London scalp, 1 to 2 hour trade, right? And this is all you need, right? This is all you need to be on the right side of the market, right? So you want accumulation, manipulation, and distribution. Remember, wicks are for manipulation, and body breaks are for essentially breaks of structure.